Hey, Professor Money followers, welcome back. And thanks for all your topic suggestions and all those likes, subscribes, and follows. And keep them coming, because money is my brand. In our latest video, we talked about the key differences between the pre-tax funded, but then taxed later, traditional IRA, and the after-tax funded, but totally tax-free Roth IRA. So which one is better for you? The choice can actually be pretty complicated, but let's make it as simple as possible right now. It starts with your income and your tax filing status. For single and head of household tax filers, and I'll oversimplify just a bit here, think of it this way. If your taxable income is over $168,000, you can't contribute to a Roth IRA. You'll have to do the traditional IRA if your income is too high. The 2026 income cutoff for the Roth IRA is $168,000 for single and head of household taxpayers, and $252,000 for married filing joint taxpayers. Okay, so Professor Money, the CPA, also needs to let you know that the $168,000 and $252,000 income cutoffs apply to something called modified adjusted gross income, not taxable income. But that's really more detail than most people need to know and that we can cover here. Now, assuming that you are not prevented from the Roth IRA by the income cutoff, should you choose the Roth IRA or the traditional IRA with the immediate tax deductions? Well, it's still pretty complicated because you have to compare the benefit of a tax deduction today offset against greater taxes in the future with no tax deduction today and tax-free withdrawals in the future instead. And that means you have to be able to predict the future, which is of course impossible. What will your income and tax bracket be 20 or 30 years from now? Will there still even be an income tax? After all, we live in a world where politics are really changing fast, and you have to think of all these things when you're planning for the future, which is what retirement planning is all about. Making matters even more complicated, if you're eligible to participate in a retirement plan at work and want to do a traditional IRA, you won't be able to deduct your contributions if you're single or head of household and your income is more than $91,000 or $149,000 if you're married filing joint. So, if we were together in my college classroom and you were taking one of my college courses in personal finance or investments already, I know what you would be saying. Okay, Professor Money, too much information already. Just tell me what to do. Okay, I'll go out on a limb to simplify your financial life. Professor Money says your best choice, choice one, if you're allowed to take the Roth IRA, do it. That's my number one advice to you. Take the Roth IRA if you can, especially if you are in your 20s or 30s or 40s. The younger you are, the more likely the power of tax-free compounding of the Roth IRA will over time outweigh the benefit of an immediate tax deduction of a traditional IRA when you are in the early part of your career in a lower tax bracket than you will hopefully be in when you retire later with greater income and a massive retirement account balance that you will have built up by taking Professor Money's advice. Choice two, if you're not allowed to do the Roth IRA, then go with the traditional IRA and grab your tax deduction right now if your income is not too high and if you are covered by the employer's plan. Choice three, if all else fails, then the traditional IRA with no tax deduction is still okay too. All are better than not saving for your retirement and having to work forever when you keep your money in a zero or low interest bearing bank account that does not keep pace with inflation anyway. But that brings us to another question. Which is better, an IRA or my employer's 401k? Or can I do both? And that, Professor Money followers, will be the subject of another video. And until then, keep those likes, follows, and subscribes coming. And tell your friends to join us so that we can all say, let's get richer together.